Hello and welcome to my YouTube channel at Alexandru. Watch this clip carefully for at least 30-40 seconds, and you will definitely understand this clip. Enjoy! Once again I welcome you to my YouTube channel. Stay with me in the next few minutes, and you will definitely understand the quality of this clip and the interest it holds. In this clip I will talk, discuss, analyze and show you about China market update, no policy lift in Hong Kong with mainland closed, week in review. Okay. Let's beat it. Week in review. Asian equities were mixed but mostly higher this week as mainland China outperformed with a gain of plus 3.43% for Shanghai, plus 2.57% for Shenzhen, and plus 8.91% for the Star Board. On Monday, Hong Kong reversed an intraday decline thanks to new rules around institutional investors' ability to sell stock short. This market support measure was followed by Huijin Central Investment, a state-linked investor, stating its intention to increase holdings of stocks and ETFs, the confirmation of the establishment of a stabilization fund, and Xi Jinping's meeting with the China Securities Regulatory Commission, CSRC, China's SEC. Alibaba reported earnings on Wednesday, beating on its bottom line but missing on top-line revenue, and increasing its share buybacks. The stock sold off on concerns about new listings, which the company said were on hold until market conditions improve, and increased expenses to defend its market share from the likes of Pinduoduo. China's inflation rate in January, reported Thursday, was minus 0.8%, while the producer price index was also negative, at minus 2.5%, though higher than the expected minus 2.6%. Friday's key news. Asian equities were mixed but mostly higher overnight, though Hong Kong closed lower in a half-day session, and mainland China was closed for the Lunar Chinese New Year holiday. At a Lunar New Year event, President Xi stated that China must build on its economic recovery progress. However, this pro-equity statement failed to lift Hong Kong-listed stocks, which were not helped by the mainland market being closed. Policy statements tend to impact mainland markets more than the mostly foreign-owned Hong Kong market. We will have to wait a week to see how the positivity from China's leader will impact mainland, onshore, share, stocks, as the Shanghai and Shenzhen stock exchanges will be closed all next week. The People's Bank of China, PBOC, released its monetary policy report overnight. In the report, China's central bank stated that it intends to ensure stable and abundant liquidity in the markets. At the same time, a state-run media outlet reported that China's inflation rate is expected to grow at a moderate clip in 2024, in contrast to the deflation indicated by the January Consumer Price Index, CPI. This can only happen with more rate cuts and stimulus. Longtime CSRC Chair Ye Human has been relieved of his post, and he will be replaced by Wu Qing, Deputy Party Secretary of Shanghai. This is further evidence of top leadership's disappointment in the market's chief's ability to stabilize stock markets and attract foreign investment. Stock markets have become a political priority for Beijing, which is a significant change from its past posture. Education stocks gained overnight on further clarification of the private tutoring policy. Real estate gave back some of its gains from earlier this week. Shipping names were lower after Maersk issued a negative guidance for the year, excluding the increase in rates due to Red Sea conflicts. Automakers broadly were lower on decreased overall car sales in 2023, though electric vehicle sales increased to over 9 million. Compared to 6 million in 2022. Hong Kong will be closed on Monday and Tuesday, and mainland markets will be closed all next week. As such, China last night will resume reporting on Wednesday, February the 14th, Valentine's Day. The Hang Seng and Hang Seng Tech indexes both closed lower by minus 0.83% and minus 1.3%, respectively, on volume that decreased minus 60% from yesterday. Southbound Stock Connect was closed. The top performing sectors were communication services, which fell minus 0.25%, energy, which fell minus 0.41%, and consumer discretionary, which fell minus 0.97%. Meanwhile, the worst performing sectors were real estate, which fell minus 3.24%, utilities, which fell minus 1.87%, and industrials, which fell minus 1.71%. Thank you for watching until the end, and I hope you understood something and liked it.